Hello, good afternoon, everyone. Welcome to today's episode of Modesty's Property Corner. This is season 1, episode number 5. I hope you're all well today. It's midweek already, and the week is almost gone again. And you'll be asking, where has the week gone to? Well, we ask the same questions every day, but we are here and we'd rather make the most of today. So today I've got something very interesting that we're going to be talking about, especially if you are in the UK and you've been following the news recently. You would remember and you would understand what we are in at the moment. Last week, the Bank of England raised the base rates to 0.5%. It was a talk of the town throughout last week and even into this week. Recently, that's what everybody's talking about, the base rates hike by the Bank of England. And a lot of people have been asking questions. What's this all about? What's this base rate thing? What are the implications? What does it mean for me as an individual? And it means a lot, and it's going to affect you even if you don't know it. You don't need to know what it is for it to affect you. But you know what? That's why we're here. That's what we're here to talk about. We want to discuss the recent base rates increase. They call it base rate hike, basically. The recent base rate increase by the Bank of England and how that impacts you as a person, and the impact it's having or it's going to have on the property market and on the mortgages market as well. So that's what we're here to discuss, and I hope that will help you understand the implications of that. And like I said, the more you know about it, the better for you, because either way, it's going to affect you. It's not about you knowing what it is or you not knowing what it is. It is just going to affect you one way or the other. So it's always useful for you to know and be in the know, and that's why we're here. So my name is Iken Naumezidike. I remain the director of Modesty Property Consultants Limited. We are based in Luton. We're sales, lettings, and management agency based in Luton. I am a qualified mortgage advisor as well. So I am within my territory to talk to you about what we are talking about today. So base rates. What is this base rate thing, and what does it really do? So let's break it down into very, very primary and simple terms for you to understand what the base rate is. The base rate is basically the rate at which the Bank of England lends money to commercial banks, to retail banks, to other financial institutions. So the Bank of England is the central bank. It is the banker's bank, right? Just like you are a customer to your local retail bank, the retail banks are customers to the Bank of England or to the central bank. Just like you go to your retail bank to borrow money, the retail banks go to the Bank of England to borrow money. And just like your retail banks gives you the rate at which you are going to borrow that money, the Bank of England gives the rates at which those banks are going to borrow money from them. So that is what the base rate is. But beyond being a rate at which they lend money to the retail banks, it's also a kind of tool, because the Bank of England uses the base rates as an economic tool to manage the flow of cash in the economy, because it's part of their job, managing the economy and managing the cash flow in the economy. So if they feel that there is too much cash in the economy and they need to mop up some of those cash, they use some economic tools available to them. If they feel that inflation is too high, they use economic tools available to them to bring down inflation. If there is need to pump money into the economy to get the economy going, they use economic tools available to them to do that. So one of such economic tools is base rates. So beyond the base rate being a rate at which they lend money to the retail banks, they also use it to control other aspects of the economy. And one of the aspects of the economy that they use the base rates to control is the flow of cash in the economy and inflation. So you might be asking, what is the relationship between the flow of cash and inflation? Inflation is simply too much money chasing too few goods and services. So if there is more money in the economy, more than the goods and services available for that money to buy, what happens to price? Retailers and service providers and sellers will put up their prices because there are too many people going for the same product, and the products are fewer than the number of people looking for it or the amount of money chasing it. So product providers and service providers will put up prices. So when they put up prices, and when prices keep going up on a consistent basis, right, that is what inflation is about. Inflation is a consistent rise in the prices of goods and services. So mark the word consistent. So it has to be consistent for it to be tagged inflation. So if that rise in goods and services are consistent, then inflation sets in. When inflation sets in, it then means that things are becoming more expensive and too expensive. Now, the Bank of England do set inflation targets every year. And if the rate of inflation is above the target that they have set and far above it, they might be looking for a way to bring inflation down so that prices of goods and services will come down. Because when prices of goods and services go up continuously, it affects the cost of living of people. On the news recently, you would have been hearing about the cost of living crisis in the UK. There's a cost of living crisis in the UK because a lot of people are being plunged into poverty on a daily basis. The basic things that they need to live on, that they need to survive, are continuously going up on a consistent basis. When they go into the supermarkets, the amount of goods they can buy, that their money can buy, is really out of place. And inflation is rising above the rise in wages. So the rate of inflation is far above the rate at which wages increase. And if that happens, it means people's wages are below, what they can afford. And that leads to costs of living crisis. So that's what cost of living is all about. So currently in the UK, there's a cost of living crisis because inflation is running away. So the Bank of England, what they did in December 2021, let's go back to what happened in the pandemic. In March 2020, on the 19th of March 2020, the Bank of England reduced the base rates to a historical low of 0.1%. 0.1%. So what it meant was they will lend money to the retail or commercial banks at 0.1%. And then the retail or commercial banks will take the money they have borrowed from the Bank of England and then lend that money on to other borrowers through their various financial products, like mortgages, like credit cards, like personal loans, your car hire purchase, and whatever financial product that are interest bearing. So whatever the margin is, whatever is on top of that 0.1% becomes the margin of the retail bank or the commercial banks. So if your mortgage is, say, 1.5%, and that base rate was 0.1% then, what it meant was the bank made a profit margin of 1.4% on top of the mortgage that they lent to you. So whatever is on top of that mortgage is the bank's margin. So you can see how this links. It then means that if the Bank of England or the central bank increases these base rates, automatically, or maybe not, right? Some of the banks or lenders will now increase the rate at which they lend money as well to you. And when they lend money to you at an increased rate, what does that mean? It means you have to pay more than you normally pay for those financial products that you have taken from the bank, which are interest bearing. So if, say, the Bank of England raises interest rates, which they did in December 2021, they now raised it from 0.1%, which was what it was from March 19, 2020, and they raised it to 0.25%. The reason let's go back to why they actually reduced it in March 2020. It was in response to the pandemic. The pandemic struck and people were losing their jobs. People were out of jobs. People couldn't go to work. A lot of people were on furlough. So they felt like the economy needed some kind of stimulus, right? And to ease the burden on people and to make money available to people, they reduced interest rate to 0.1%, so that the banks can borrow money at historically low rates and lend it at historically low rates as well, making the cost of borrowing very, very cheap and making credit available. And when they make credit available, people can borrow money like to buy properties. People will now be encouraged to spend, because when borrowing is cheap, people spend a lot of money. So people now looking at mortgage rates at then and thinking, oh, mortgages are very cheap. I think it's a very good time to buy. And they went on and they started buying properties and spending money and wanting to move. So it kind of got the economy going at the time. People who wanted to take credit cards, for example, if they find that the interest rates are very, very cheap, they can go and take a credit card or loan to spend on, buying things that's how they stimulate the economy using the base rates. Okay, so when they did that in 2020, it was to stimulate the economy and help ease the burden that the pandemic brought upon us in the UK. Now, fast forward on to 2021. What happened was that, because not just the reduction of base rate to the historical low, the Bank of England did use what they call quantitative easing as well. It's called QE. It simply means pumping money into the economy. That quantitative easing, they use different mechanisms to implement it. There was the bounce back loan. There was the furlough scheme where they paid people 80% of their wages, whether or not they were going to work. There was support given to businesses, to lending businesses money, and they didn't have to pay any interest for a certain period of time. So there was so much money pumped into the economy to get the economy going. So that quantitative easing meant that there was so much money in circulation. Now, because there was so much money in circulation during that pandemic, a lot of people were not going to work, but they were richer and wealthier, even more than when they were going to work. So all that money were now chasing few goods. Because with the pandemic came other issues like logistics problem. A lot of stores and shops and businesses found it difficult to order stuff into their stores. Even after the lockdown restrictions were lifted, you could hear logistic problems. The importing things from abroad became difficult because there was scarcity of containers. People couldn't import. So provision of goods and supply of goods were also affected by the pandemic. When this happened, there were too few goods available, but there was too much money chasing those too few goods. We also experienced scarcity of fuel at some point here in the UK. So all these things contributed to inflation running wild, wilder than the Bank of England could even anticipate. So as of December 2021, inflation was hitting 5%. And remember, the Bank of England inflation target is 2%. So the margin between the Bank of England target and what the actual inflation rate is wide. They had to bring inflation under control. Otherwise, if they allow inflation run wild, it's going to get catastrophic. So the Bank of England felt that they had to do something. So the first tool available to them that they called upon was to increase the base rate from 0.1% to 0.25% in December. When they increased the base rate to 0.25% in December, they wanted to see what impact it was going to have. Some lenders put up their variable rate mortgages or some other financial products. They put up the rates, all right? And they looked at the impact that rate hike had I think it was just minimal. It didn't affect inflation that much. So, because every month the Monetary Policy Committee, MPC, of the Bank of England meets every month to review rates and the base rate and other things. So they met again in this new year, and on the 3rd of February, there were about 9 people in that Monetary Policy Committee that made a decision on whether to increase rates again or not, because they had to take a vote. So they voted 5 in favor and 4 against. So 5 were in favor of raising the base rate again, 4 were against. But pay attention to the details of this. The 4 people that voted against raising the base rate actually wanted the base rate to be increased higher than what they were proposing. Not that they were against raising the base rate, but they are actually saying that that wasn't enough. But with that very tiny, margin, they voted in favor of raising the base rate again to 0.5% from 0.25%. So it increased from 0.25% to 0.5% on the 3rd of February 2020. That decision was made. So that's where we are at the moment. And that's where we now want to ask, so why did they decide to increase rates? From what we have explained so far, inflation was one major reason. Cost of living was getting out of hand. People were finding it difficult to buy the necessary things. And now, the scariest thing now in the UK is April, when it is expected that cost of gas and electricity, the cost of heating people's home will get out of the roof, because there is serious shortage of supply from the wholesale point. The wholesale price of gas has gone up significantly. So gas and utility providers are going to put up their prices to match up with the rates at which they buy those gas, at which they buy the gas at wholesale prices. So heating costs is going to be hit badly by April. So people are really scared of this thing. So if you now add, the expected hike in heating costs, you add the cost of living that is getting out of hand in the UK, and then if you've been buying petrol recently, you realize that the cost of fuel and diesel have gone up as well. So all these things put together means that if the Bank of England doesn't do anything and these things keep rising at the rate they are rising, life is going to be hell for people. So they decided to put the base rate up. Now here is the other side of it. Putting the base rate up now has its own implications on the other aspects of people's living. Mortgages. Putting the base rate up then means that if the lenders decide to go by the base rate hike, they are going to put up the rates on their mortgages. And people who have mortgages will find out that their mortgage payments, monthly payments, will increase, especially those who are on variable rates. We're going to come to that later. But that was why the Bank of England decided to increase the base rates. So what does this mean for the property industry here in the UK? Some experts have already said that because of this, there's going to be a serious squeeze on people's finances at home. And because of that squeeze, people are going to find it difficult to really make big purchasing decisions. That if people are going to be budgeting more smartly now, and people are going to be considering whatever they are spending, making sure they get good value for money. Because imagine your mortgage payment going up, cost of living going up, cost of fuel going up, and cost of other things going up. It's a squeeze on your personal finance. The implication of that is that you're going to be looking for ways to save money. So people might not fancy buying properties at this moment in time. So they are saying that it might halt the current property boom that we're experiencing in the UK. That's one school of thought. Another school of thought have looked at it and said, I don't think that's going to happen, because the demand that we have in the property industry now The demand for properties now is so strong that even this slight increase in the base rates and even a slight increase in mortgage rates are not going to put people off, because people want to move. Buyers and sellers are more determined than ever to get the deal done. Sellers want to move. Some sellers want to move as well. So they want to sell their property and move to a bigger property. There are desperate buyers who are looking to buy properties, so the recent base rate hike may not have the effect that people thought it was going to have. So those are two schools of thought in terms of the implications of the base rate hike on the property market and how it's going to affect buyers and sellers. Now, between these two schools of thought, you will be thinking, so who do we take seriously? How do we know who is right and who is wrong? But that tells you what the characteristics have been of the property industry since the pandemic in the UK. Uncertainty. There has been the property market in the UK since the pandemic has defied all odds. When people thought that the properties were going to crash, property prices are going to come crashing, it never did. Demand became even stronger. In 2020, when the pandemic came, there was so much doom and gloom about saying that the property market is just going to collapse. The government did very well to come and boost the property market with the stamp duty relief, and other incentives that they came up with. It helped. And then the demand for space and the demand for bigger properties now took over. The stamp duty relief played its part, but the biggest part was played by the strong demand for properties. People were really, really willing to move. So the question then is, because now going into 2021, people now thought, in 2021 there will be a price crash, and then the whole property market will come collapsing. Let's relax. 2021 ended with property price growth hitting double digits. All right, so that was like, wow, we haven't seen anything like this. 2021, 1.5 million homes were sold in the UK, the highest ever so far. So, and that was when people were thinking that the property price or property market was going to crash. It didn't crash. It was going from strength to strength. So with this recent base rate hike, what are we thinking? Personally, what I'm thinking is the UK property market has seen even worse situations, and they have defied all those odds. From what we have seen in our estate agency and our mortgage business, we haven't seen demand slow that much. People are still desperate to move. People are still hungry to buy properties. They still want to buy. The base rate hike to 0.5% will not be it will not stop the demand. It will not spell the end of the property boom, as far as I'm concerned. It might sow some seed of doubt and thought, might make people think twice about buying. But the urge, the hunger to buy, the demand is still there, and that is the biggest driving factor in the UK property market. So I personally do not think that, because listen, 0.5% base rate, it was the same thing as 2009. As at 2009, the base rate was 0.5%. And at that time, people were screaming that it has never been this low. And it remained like that for 7 years. So for that 7 years, the property market in the UK was experiencing, very good growth rates. So at this point in time, I don't think 0.5%, because we have been spoiled by very historically low base rates, such that 0.5% now means a lot. People are now like jittering and scared and thinking, 0.5%, the whole world is going to come crashing. It's not going to make significant difference in people's choice and decision to buy or not to buy. However, where I think is going to have some kind of influence will be in mortgages, right? Where people who have variable rate mortgages might see their mortgages go up. Analysts have said that people's mortgages, about 1.2 million people in the UK, will see their mortgage go up by as much as £700 in a year. If you break £700 in a year down, that's about 50 or 60 odd pounds a month increase. So if your mortgage payment goes up by £60 a month, for example, you are on variable rate. To some people, that's a lot. It's going to affect, they're going to have to cut down on some other things for that month so that they can accommodate that increase in their mortgage payments. So if you're on variable rates, you are most likely going to see your mortgage payment go up, because variable rates are usually mostly affected whenever base rates go up. It's not a given that your bank will raise the variable rates, but most banks do when base rates go up. If you're on a tracker mortgage, right, because tracker mortgages are directly linked to the base rate. It's called tracker mortgage because it tracks the base rates. Whatever the base rate does, the tracker mortgage does. If the base rate goes up, the tracker mortgage will go up. If the base rate goes down, the tracker mortgage will go down. So if you're on a tracker mortgage, you are most likely going to see your mortgage payments go up because base rate has gone up, because that is what the tracker mortgage does. Unless your lender decides to keep it as it is. But your lender will always communicate to you what their decisions are regarding your mortgage rate, whether it's going up or it's going down. If you're on fixed rate mortgage and you are fixed it for say 2 years, if that 2-year fix is ending in this year, yeah, you find out that when you go to search again and search the market, there might be products that have gone up in price. Rates would have increased, but you do well to fix it again. If you're on 5-year fix and your 5-year fix is ending this year, you might find out that the same thing is going to be applicable to you. You might find out that some rates have changed and some rates have increased. The rates that you had 5 years ago are not going to be the same thing now. But it's good for you to go again and fix it again so that you can protect yourself from further rate hikes. And guess what? The prediction and the projection is that there will be further rate hikes. The base rate is going to go up again. That's the projection, because by April it is expected, or it is projected, that inflation, even the Bank of England said by April, inflation will hit more than 7%. So there is an indication there that there might be another base rate increase, which means mortgage rates might go up again later on in the year. So there's no guarantee that base rate won't go up again a couple of times more in this year, because nobody knows what's around the corner. So the unpredictability of the economy and the markets means that if there is any way you can protect yourself against these unpredictable situations, do it. For mortgage borrowers, go and get fixed rates. Yeah, fix your mortgages. If you want to fix it for a longer term and it suits your goal and your objective, do it. But if it doesn't suit your goal, it's not for everybody. It doesn't mean that because base rates are going to go up, everybody's going for a longer term rate. To some people, they might want to come back into the market in a short while, maybe to take out equity from their property or to remortgage again and raise some capital from their property. That would be what they want to do. If they want to do that, they can just fix it for 2 years and come back 2 years, raise some capital and fix again. But if you're on variable rate and you can fix, please go and fix your mortgage so that you can protect yourself from this situation where it's expected that base rates are going to go up again. And if you're on tracker mortgage, speak to your lender and see if there's an early repayment charge applicable to your tracker mortgage if you want to get out of the tracker mortgage onto a fixed rate. Otherwise, you might have to pay an early repayment charge if you get out of your tracker mortgage earlier than you have fixed it for. All right, so that's where we're going to call it a day today. Thank you so much for keeping a date with us. I hope this has been useful to you. And if it's been useful to you, please share our videos, tell your friends, tell your neighbors, tell your enemies that something good is happening here. And I'm going to see you guys again next week, Wednesday, for another bumper session of Modesty's Property Corner. Thank you very much. God bless you and see you next time. Bye now.